Everybody, it is Friday the 16th of August 2019, and the market did lose a little bit of ground here this week, but not nearly as bad as it had been a couple days ago. We came back nicely here today in the S&P 500, trimming the losses for the week to just about 1%. And the Russell was the worst in spite of a 2% rally today. So let's take a look at the charts, and here's the daily chart of the S&P 500. The 20-day moving average just crossed down through the 50-day moving average. Not a big deal. It happens. The moving averages tend to occur after movement, so they're not necessarily a timing tool, so don't be too concerned about that. But we are still kind of stuck in a range here. If we look at a 30-minute time frame, it's probably easiest to see here that this has been the band of resistance and this has been the band of support in this bigger range that we've been in pretty much since the beginning of the month. So we're kind of right smack in the middle of that range. We're just above the volume weighted average price from the low, and we're at a 5-day moving average. Basically what the intraday time frames are telling us is that we've got a big mess here. The daily time frame says we're still in a longer term uptrend. I think it's still possible that we can see a test of the 200-day moving average in this volume weighted average price, and it's going to take, of course, some kind of headline that takes people off guard. I don't think the volatility is over. So overall, you have to continue to be cautious. I think until we get back above and hold above 295, it's still going to be a sloppy market. So the good news is most of the earnings are out of the way. We've got that as far as a catalyst no longer really a big concern in the near term. We do still have the yield curve and the trade war to deal with, but overall, the market, had a pretty good week, I think. And you have to consider we're only about 4% off of all-time highs, and we're still up on a year-to-date basis. For the S&P 500, 15.5%. So it's tough to be bearish, but you look at the intraday volatility, it makes it seem a lot worse than it has been when we've done nothing really for the last 2 weeks here. Going over to the Nasdaq, kind of the same story here, that we have the 20-day about to cross to the 50, and we've got this bigger band that we're in. When we look at a 30-minute time frame, here's that band of resistance up in here, and here's that band of support. The good news is in this market, we've made a slightly higher low. If we do come back down, though, I'm thinking that, because of the amount of time that we're spending consolidating in here, we might not get the quick bounce off of those VWAPs and 200-day moving averages that I was hoping for anymore. Instead, we might end up going down like the Russell 2000 did to just slightly undercutting the June lows. And as I was mentioning to subscribers this week, that undercut of a new low is most likely, in a buy point. People say, well, it's the definition of a downtrend. We have lower highs and lower lows. Well, we had a higher high up here that trapped everyone. We had a lower low that trapped, trapped longs up here, that trapped shorts under this level, because we have to always say, where has the market come from? It had just dropped down. We are still stuck below the 200-day moving average in the year-to-date VWAP, so this still looms as an area of large interest as potential resistance up between basically 151 and 152. Keep that in mind. Don't get too excited about this bounce. It is a bounce within a downtrend. We were able, that is, to close above the week-to-date volume-weighted average price. So, from that perspective, it's good. I think next week, if the Russell's going to continue to bounce, maybe we get a little bit of a pullback and then continue higher. But again, it's difficult to trust with a declining 20, 50, 200-day moving average and below the volume-weighted average price from the December lows. Semiconductors really have stubbornly held on this week to some key levels. That is the volume-weighted average price off of this low. You can see that's the purple line in there, and that comes together with the volume-weighted average price off this prior peak. We are holding above that, and we actually closed above the rising 50-day moving average. So the semiconductors still overall, I think are in need of further time consolidation to digest the gains that they've had. The volume-weighted average price off the all-time high has been holding as a place where sellers have shown up. So be aware of that next week if we get up towards that 113.5 level. And again, be aware of trying not to chase. If it breaks beyond this level, you have to ask yourself, where had it come from? Do you want to buy there or wait for the pullback and then buy at a point like this that makes more sense, where you could put a stop then underneath that higher low if it does in fact prove to be one. The biotechs are still, I consider, guilty till proven innocent, highly suspect, until they can get back above 106, 107. That's where we have the 200-day moving average and the volume weighted average price from the December low. We did make a higher low this week for now, but overall, bigger picture is still pretty ugly. When you look at the weekly time frame, it's a big mess, and I just don't see the advantage to being long or short in here with all this choppiness. It's difficult to make money in either direction unless you're looking for just quick moves intraday. And I think that's the same for all of these markets, especially when you look at the S&P 500. You clear everything off and just look at the gaps that we've had. Every day we're seeing these large gaps, and one day they gap up and reverse, the next day they gap up and continue. So it's been a choppy environment, and that's what makes it feel worse than being down 4.5% or whatever we are. The financials this week kind of did a little bear trap of their own by getting underneath this prior low and then rallying from that level. So very similar to the Russell 2000 in that they broke the prior low and then were able to quickly get the shorts to cover and create new demand in there. But when we look at this financial group, we're right at that 200-day moving average. We're right at that not the year to date, but the volume weighted average price from the low. And now, what I think is most likely, maybe we get some further bounce, but if we create another lower high, that could pave the way for bigger downside. So you have to be, aware of that. Bigger stocks like Google are still trying to hold on in here. They've pulled back from that earnings and are trying to stabilize right now. Twitter still looks like it has the possibility of holding on here. It held above this low still, and it's still got that rising 20-day moving average and holding above this prior resistance. It tested it, but it's we've got, I think, a clear level of to set your stops against, which is this low over here. So there's still opportunities out there. CSIQ reported earnings. But you've just got to be more, a lot choosier, that is. Newmont Mining, I'd pointed out that this one seems to be building energy. It's been a laggard in the gold group, but maybe the energy can build for that one. So keep an eye on that. Keep an eye on Tyson Food, TSN. It's, on the weekly chart, it's had a nice run, but then it consolidated and made this really nice ascending triangle here, and it's broken from that. Now it's consolidating once again on lighter volume. So there's still opportunities out there. DHI is still one to keep an eye on. And as I mentioned, this is what I do every single day for subscribers. I do a video where I take a brief look at the indexes, all these ETFs that we talk about each week, and then I have another video with actionable ideas. So take a look at Alpha Trends if you haven't already, and have yourself a good weekend.